Start by asking, are you looking for a safe way to grow your money? Introduce the concept of bonds and their importance in the world of investing. Are you struggling to find low-risk investment options with stable returns? You're not alone. In today's volatile market, the search for secure investments can be a daunting task. Let's dive into the world of bonds. Bonds are essentially loans that you give to companies or governments in exchange for regular interest payments. They are considered a safer investment compared to stocks because they offer a fixed income stream and are less volatile. There are various types of bonds available for investors, including government bonds, corporate bonds, municipal bonds, and more. Each type has its own risk and return profile, so it's essential to understand the differences before investing. Investing in bonds can be a great way to diversify your portfolio, generate steady income, and manage risk. Here's a step-by-step guide for beginners to help you get started with bond investing. 1. Understand what bonds are. Bonds are debt securities issued by entities such as governments, municipalities, and corporations to raise capital. When you buy a bond, you're lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. 2. Know the different types of bonds. There are several types of bonds, each with its own characteristics and risk profiles. Government bonds, issued by national governments, e.g. U.S. Treasury bonds. Municipal bonds, issued by state or local governments, often tax-exempt. Corporate bonds, issued by companies, typically offer higher yields but come with higher risk. Savings bonds, government bonds for individual investors, e.g. U.S. Series 1 and EE bonds. Agency bonds, issued by government-affiliated organizations, e.g. Fannie Mae. 3. Understand bond basics. Familiarize yourself with key bond concepts: face value, par value, the amount paid back to the bondholder at maturity. Coupon rate, the annual interest rate paid on the bond's face value. Maturity date, the date when the bond's face value is repaid to the bondholder. Yield, the bond's return based on its current price and interest payments. Credit rating, assesses the issuer's creditworthiness, e.g. AAA is high, D is low. 4. Assess your investment goals and risk tolerance. Determine why you want to invest in bonds and how they fit into your overall investment strategy. Income generation, bonds can provide regular interest income. Preservation of capital, bonds are generally less volatile than stocks. Diversification, bonds can help balance the risk in a stock-heavy portfolio. Risk tolerance, consider how much risk you're willing to take, e.g., higher yields often come with higher risk. 5. Research and select bonds. Carefully select bonds based on your goals and risk tolerance. Credit quality, choose bonds with an appropriate credit rating for your risk tolerance. Maturity date, align bond maturities with your investment horizon. Yield considerations, compare yields to find the best return for your level of risk. 6. Decide how to purchase bonds. There are several ways to buy bonds. Direct purchase, buy individual bonds through a brokerage account. Bond funds, invest in mutual funds or ETFs that hold a diversified portfolio of bonds. Treasury direct, buy U.S. Treasury bonds directly from the government. Municipal bond dealers, purchase municipal bonds through specialized brokers. 7. Open a brokerage account. If you're buying bonds directly or through funds, you'll need a brokerage account. Research brokers, compare brokerage firms based on fees, services, and investment options. Account types, decide between a standard brokerage account, an IRA, or another type of account. Set up your account, follow the broker's instructions to open and fund your account. 8. Place your order. When you're ready to invest, follow these steps to place an order. Select the bond. Choose the specific bond or bond fund. Determine the quantity. Decide how much money you want to invest or how many bonds to buy. Choose the order type. For individual bonds, specify the type of order, e.g., market or limit order. Review and confirm. Double-check your order details and confirm the purchase. 9. Monitor your investments. Keep track of your bond investments to ensure they align with your goals. Interest payments. Monitor the receipt of interest payments. Credit ratings. Stay informed about any changes in the issuer's credit rating. Market conditions. Be aware of interest rate changes and economic conditions that could affect bond prices. 10. Rebalance your portfolio. Periodically review and adjust your bond holdings as needed. Diversification. Ensure your portfolio remains diversified across different types of bonds and other assets. Reinvestment. Consider reinvesting interest payments or proceeds from maturing bonds into new bonds. Adjustments. Make changes to your bond portfolio to maintain alignment with your investment goals and risk tolerance. Investing in bonds can be a rewarding way to generate income, preserve capital, and diversify your investment portfolio. By understanding the basics, assessing your goals, and making informed decisions, you can successfully start investing in bonds. Remember to regularly review and adjust your bond investments to stay on track with your financial objectives. Now let's talk about the benefits of investing in bonds. One of the key advantages is the fixed income they provide. Unlike stocks, which can be unpredictable, bonds offer a steady stream of interest payments. Additionally, bonds are generally less risky than stocks, making them an attractive option for conservative investors. In conclusion, investing in bonds can be a smart way to diversify your investment portfolio and reduce overall risk. Remember to research and understand the different types of bonds available before making any investment decisions. Don't forget to like and subscribe for more valuable content on investing and personal finance. Thank you for watching.